All right, everyone, welcome back for another episode of This Week in Charts. My name is Aaron Basil via Carnivore Trades, and we're on the Wall Street for Main Street channel. Market's staging a pretty nice rally this week, especially today after the what was considered dismal non-farm payroll number. And we'll break that down a little bit later. But right now, we're going to start off with the dollar index, which is actually been absolutely getting bludgeoned over the last couple of weeks and really over the last year, as most of us are aware. So why we're going to start off with the dollar index here is we've been in a, what we would say, like a 6-year trading range here. The low being about 88, 89. We've gotten up to highs about 102.50. And why this is significant now is that it is in the interest of the Federal Reserve, obviously, to have a weaker dollar. It's in the interest of the stock market to have a weaker dollar. However, if we are to lose support around 88, 89, and we were to break below this area, and we have the 200 moving average here, but outside of that, if the dollar were to go into, say, a free fall mode, that would be terrible for the market. And you might say, well, why is that? A weaker dollar is good for equities, means there's cheap money coming in and pedal to the metal. Yes, but the market wants a controlled decline. The weekly, it wants a slow descent. It doesn't want, see on the daily here, it wants just kind of a grind lower. The market, if the dollar was just flushing lower day after day after day, and it was just in free fall mode, then that would freak the market out. And so it's in the interest of the Fed also to keep the dollar kind of in the tug of war area. Now, at this point, we have this little trend line right here. If this breaks, it's probably going to go back down and test 89. This is something we're going to have to watch. Now, it could reverse off of this and move higher. Again, I am expecting, a market correction, a big correction, actually. And I think we are very close to a blow-off top in this market. So that is a possibility that we can happen. However, this chart's not looking good. It looks like a dog with fleas, honestly. If you look at, we're going to take a look over here. I mean, just look at commodity prices. Let's look at corn. Corn's just ripping higher. I mean, you had this big doji. A lot of times you'll see the market reverse when you have this gap up and you have a doji candle, and then you have a big gap down the next day. Look at that, rallied right back up, took out the high. We look at a monthly chart of corn. This is ridiculous. I mean, you're almost up to all-time highs in a matter of about 10 months, I think. You got 10 green candles in a row. Corn's gone parabolic. Copper made a new all-time high this week. So that is up to new highs. I'm not sure if this can sustain. In fact, I know parabolic charts can sustain. However, it could continue to make new all-time highs. If it consolidates or what and not. I don't know if it's going to crash. I don't know what's going to happen. I know that there's a lot of problems out here. At some point, these are going to put pressure on the economy. As we look at lumber here, we've all seen the chart of lumber. I mean, look at this. These charts are going to put pressure on the economy. I mean, there's only so high prices can go before people just can't afford things anymore. If we look at crude, I talked about crude in a short video on my YouTube channel Monday and Tuesday. And if you notice, we had this little inside bar here. See this inside bar, and we finally closed above that. So now crude can really take off to the upside. We look at a longer term chart of crude here. That's a breakout. That's a breakout of a very long-term trend there. And now you've got a nice little pullback, and now maybe crude consolidates a little bit. We want to push up to $70, $75 a barrel. So all these commodities going parabolic. Crude not so much, but I mean, the prices are high. Prices are very high. Have people not even back to work. And prices are, I mean, velocity of money has crashed. So it's still very low, and prices are going up parabolic. There's a chicken wing shortage nationwide. There's every type of shortage, every type of price increase you can think of, pretty much across the board right now. And the Fed wants to pretend that it's transitory. Well, it may be transitory in the sense that it's going to crash the economy. So that's something that we're going to have to take definitely going to have to keep an eye on. One of the things that is very important to point out, and I came across this earlier this week, is the lumber to gold ratio is now at levels that we haven't seen since 2005. Now, the lumber to gold ratio is important because lumber essentially is a risk, it represents risk assets, it represents strength of housing, and gold is, as we know, a risk off asset, it's a safe haven, a store of value. If lumber starts to crash, that could be telling us that the market is getting ready to put in a top or a period of increased volatility. And speaking of gold, let's take a look. What's gold been doing lately? I know I've been on here every week talking about the price of gold. Oh, look, breaking out again. Very close to the 200 moving average. And we've broken above this channel here that we've been stuck in since really late August. And gold looks like it wants to move up to 1900, and eventually it's going to test 1950. You can get this line in here. There we go, 1950. And if you get through that, it's really new all-time highs. So we're looking at the potential for the gold to lumber ratio to tell us there's something going on in the economy. I mean, we got parabolic commodity prices. We've got massive unemployment, and we've got people who aren't even looking for work because they're just getting a government check. And there's employers that are desperately trying to raise wages to hire people, and people aren't even coming back to work. So there's lots of problems out there, and I think we're getting close to a blow off top scenario. And as we shift over here to the S&P 500, again, we talked about how we staged a nice rally this week, made a new all-time high. Nothing wrong with the market from a technical vision, other than the fact that you are parabolic on the monthly time frame, which is the most dominant time frame. However, underneath the surface, there are many problems that are not really showing themselves broader market. QQQ, the NASDAQ 100. Notice how we had this bullish pattern here. So we had this bullish pattern move up, and then we had this sideways consolidation. We were kind of flagging here for a move higher. Well, that pattern has failed. Earlier this week, we sold off, we broke formation, and then we retested this gap fill today and the 20 moving average and closed below it, despite closing positive on the day. And technically, NASDAQ also closed lower on the week. Again, NASDAQ 100 lagging is not a good thing. I've been basically beating this dead horse. The NASDAQ lagging for as long as it has, and the Russell lagging for as long as it has, is not bullish. Not bullish to have the Dow and the S&P for as long as they have been. If we look at some other stocks here, just like these risk names, actually, we'll take a look over here. I know Jason posted this earlier this week in a video from Tavi Costa. As we look at Kathy Wood's fund breaking below support here, software stocks and some of the SPACs, the high growth names, are now underperforming. And we talked about, I think in the first video, we talked about Viacom and these on the Archegos debacle. Well, now you're seeing a lot of other, like, for instance, Kathy Wood. There's a lot of people who follow Kathy Wood's trades, a lot. And a lot of them have lots of money. A lot of them are other hedge funds. Again, they pile into trades together. With these funds rolling over like this, there is going to be a problem. There may be more margin calls. There may be more funds that go underwater. This is the type of thing that can crash a market. Look at some of these growth names and stocks that outperformed. Teladoc, At broken through support, looks like a dog with fleas. Peloton, Head and Shoulders, broken down. Let's see, Plug Power. I mean, look at how this was a $75 stock in January. That's $23 now. Twitter was another high flyer, back down to $50. Airbnb. I mean, this thing 220 all the way down to 150. Coinbase. It's pretty much gone down in a straight line ever since it IPO'd. I mean, there's also, look at the semiconductors. This is a very important index to follow. Semiconductors making lower highs. Cloud software not making new all-time highs. This is an ugly chart too. In fact, this is a good trend line to watch here. Right in this area, breaks this. You break this trend line, essentially the 200 moving average, this thing's probably going to go all the way down to 300. So there's a lot of problems across the board that they're not really showing themselves. They're kind of cracks in the armor. They're underneath the surface. Once you peel the market back a few layers, you start to see some ugly things going on. Speaking of which, this is hugely significant. I just read the commitment of traders today. And if we look here, a screenshot I took, if you've been following the COT reports for the last, I would say, like, I want to say 3 or 4 months, probably more than that, the commercial positions, which is the institutional positions that you want to follow, they've been net long for a long time. Well, guess what happened this week? They are now net short. They added 8,100 contracts short and removed a bunch of long contracts. Now, it is important to note that the retail positions are still net short, but they removed almost 8,600 short contracts. So we're seeing retail start to bail on the short positions, and we're seeing Wall Street and the big money that has money to move markets, we're starting to see them flip to the short side. So if this trend continues and we see retail flip long and we see commercial flip short furthermore next week, that's going to be a very, very bearish signal for this market altogether. So with all that said, I'm going to wrap this video up. If you're not subscribed to Jason's Patreon, make sure to drop him a sub there. It's only $5 a month. And again, you can follow me at my Twitter at Aaron Basil, or at my YouTube, which is also at Aaron Basil. And I'm going to try and put out a few more videos, even if they're just short, quick ones throughout the week on there. So anyways, take care, guys. Have a great rest of your weekend. Thanks.